For decades, gold has been the ultimate fortress for central banks, but as of July 2026, the world's biggest financial institutions are doing the unthinkable. They are quietly dumping their gold bars to hoard Bitcoin as their primary collateral. Is the digital gold narrative finally dismantling the global banking system's oldest tradition? This isn't science fiction or crypto Twitter hopium. It's a structural shift that's already beginning in pockets of institutional finance. Programmable scarcity is starting to outperform physical bullion in the high-speed 24/7 world of modern markets. Today we're breaking down the great collateral swap. Why it's happening, how it works, what the data shows, and what it really means for the future of money. This is the Signal and Noise podcast. Take a moment to like and subscribe. Make sure to watch to the end so as not to miss a special signal. Collateral is the grease that keeps global finance moving. In lending, derivatives, repo markets, and prime brokerage, institutions post assets to secure obligations. This allows rehypothecation, the reuse of the same collateral multiple times across the system, amplifying liquidity and leverage. For centuries, gold has been the ultimate hard collateral. Scarce, durable, verifiable, with effort, and trusted across borders and cultures. Central banks still hold massive gold reserves as a strategic asset. But modern markets have problems gold struggles with. Its physical leads to slow and expensive to move, store, insure, and verify at scale. Settlement can take days, T+1 or T+2 in traditional systems. It's not easily divisible or programmable for complex financial contracts. In high-frequency or 24/7 environments, crypto markets, global trading, physical assets create friction. Enter digital assets. Bitcoin, with its fixed 21 million supply enforced by code, offers programmable scarcity. It's instantly verifiable, globally transferable in minutes, divisible to 8 decimal places or more with layers, and can be used in smart contracts. The question isn't whether gold is bad. It's whether Bitcoin solves real pain points in collateral and rehypothecation better in certain environments. Let's compare the two head-to-head. Scarcity, gold, geological and mining limits, new supply approximately 1 to 2% per year. Bitcoin, hard capped at 21 million by unbreakable code. Verifiability and trust, gold, requires assays, vaults, audits, costly, and slow. Bitcoin, transparent blockchain, anyone can verify supply and ownership instantly. Transferability and speed, gold, physical shipment or allocated accounts, days/weeks. Bitcoin, global settlement in minutes or seconds on L2s. Perfect for high-frequency rehypothecation, divisibility and programmability. Gold, limited bars and coins. Bitcoin, highly divisible plus smart contracts enable automated collateral management. Liquidation and complex derivatives. Storage and cost, gold, physical vaults, insurance, security, expensive at scale. Bitcoin, digital custody solutions, though not without risks. 24/7 and global accessibility, gold, traditional markets have hours. Bitcoin, always on, borderless. In rehypothecation chains, where the same asset secures multiple obligations, speed and verifiability matter enormously. A tokenized or Bitcoin-based collateral system can move faster, with less friction and counterparty risk in digital environments. This is why we're seeing experiments with tokenized assets in Bitcoin in collateral contexts. It's not replacing gold everywhere overnight. It's gaining ground where efficiency wins. This isn't pure theory. We're seeing real movement. Bitcoin ETFs have become massive vehicles for institutional exposure. With AUM in the tens of billions, they act like digital gold ETFs but with better liquidity. Corporate and institutional balance sheets increasingly hold Bitcoin directly. This normalizes it as a treasury/reserve asset. Tokenized collateral pilots, JP Morgan's Onyx and work with CME Group have explored tokenized assets. These allow faster programmable settlement. In crypto native and hybrid finance, Bitcoin is already used extensively as collateral in lending protocols. Gold markets remain huge and trusted for central banks and traditional portfolios, but growth in new collateral demand creates space for alternatives. The Great Swap is most visible in new or high-velocity segments rather than a wholesale dump of existing gold holdings. Banks and institutions are adding Bitcoin exposure alongside gold. The migration is happening on the margins first, where programmability and speed deliver clear ROI. Long-term holders and on-chain data also show strong conviction in Bitcoin's scarcity narrative, which supports its use as hard collateral. Rehypothecation is where the real leverage and efficiency gains live. In traditional prime brokerage, collateral gets reused across multiple parties. This multiplies liquidity, but also creates systemic risks. Bitcoin and tokenized assets change the game. Instant verification and transfer reduce settlement risk. Smart contracts can automate margin calls, liquidations, and reuse rules transparently. 24/7 operation matches global markets. In high-frequency environments, algorithmic trading, cross-border settlements, physical bullion creates drag. Digital assets remove it. Before we get carried away, let's be precise. This is not a complete or immediate replacement of gold across all global banking collateral. Gold remains deeply embedded in central bank reserves for good reasons, historical trust, and no counterparty risk in physical form. Bitcoin brings new risks, price volatility, though less relevant for collateral if hedged, and custody and security issues like hacks. Regulatory uncertainty in some jurisdictions and liquidity concentration in certain venues. The shift is emerging and uneven. Traditional core collateral still dominates many rehypothecation chains. It's better framed as digitization and diversification of collateral. At its core, this reflects a deeper change. Decentralized code is becoming systemic bedrock in parts of finance. Gold's scarcity is physical. Bitcoin's is mathematical and enforced by global consensus. In a world of programmable money, code-based scarcity has unique advantages. We're moving to an era where collateral can be digital and verifiable in real time. This doesn't erase gold's role, it expands the toolkit. Institutions aren't acting on ideology, they're following efficiency, risk management, and opportunity. Where Bitcoin solves problems better, it gains traction. Looking ahead, expect more pilots and production use of Bitcoin/tokenized assets in collateral and rehypothecation. Hybrid models will likely dominate. This strengthens Bitcoin's monetary premium as it moves from speculative asset to institutional infrastructure. Gold markets will adapt to these shifts. For the broader system, this could mean more efficient capital allocation, but also new systemic risks. The great collateral swap is less a sudden revolution and more a quiet, ongoing evolution driven by technology meeting institutional needs. The bedrock of finance is shifting, not because gold failed, but because Bitcoin offers compelling advantages in speed and verifiability. Global banks are exploring and, in places, already using digital assets as collateral. This is a structural pivot worth watching closely. It signals that decentralized code is earning its place as systemic infrastructure. What do you think? Is this the beginning of Bitcoin becoming core collateral? Or will gold's centuries of trust keep it dominant? Drop your thoughts in the comments, subscribe, and hit the bell for more institutional analysis. What do you want us to discuss next? Why global central banks are testing atomic settlement? Or why traditional exchanges are rushing to on-chain order books? This is signal and noise. The collateral is changing, and so is the game. Stay informed.